The cloud. Okay, so now we're recording, and hello everybody. Welcome to our Friday Zoom at noon, where we talk about everything entrepreneurial related. I'm Dr. Dale Caldwell, your host, the executive director of the Rothman Institute of Innovation and Entrepreneurship. Sue Slavin and Maura Panuski are out there watching and are part of our team. Matt Wells is a new part of our team, and we're just so excited. He's running the FDU Small Business Development Center. And many of you may have seen the video of him speaking. And Tom Hofstetter from Schenck that I've gotten to know is going to provide some real information. So get a pen, get a paper, grab your lunch. This is going to be interesting. Just real quick, the Rothman Institute of Innovation and Entrepreneurship at Fairleigh Dickinson University. Our focus is to promote, support, and research entrepreneurship with a focus on family, veteran, student, and urban entrepreneurship. And now with the addition of the SBDC, we can really help to provide hands-on free consulting services to small businesses. And so with that, Matt, did you want to just say a little bit about your background, and then we'll jump right to Tom?
Yeah, so I've been a long road up and down through the SBDC. So I came in as the SBDC as a student, led to an internship, then led to being a junior consultant, senior consultant. Now I've taken over this center here. I've sort of lived and breathed small businesses for pretty much most of my life. I owned and operated a family small business for about 15 years, sold it off in 2015. And during that time, I spent a lot of my free time outside of the business, also consulting to the SBDC. So a lot of the clients that we do see on a daily basis, I mean, most of myself and my consultants here at the center, we've been through just about everything you can think of. So we try to help businesses in any means we can. And most of the time it's spent on helping getting financing, working on a business plan and getting open. We would do everything from growth strategies in the midterm to turnarounds on the other end of that too. So we cover the whole spectrum here at the SBDC.
And you provide really hands-on advice for SBA lending and some of the things that Tom is talking about. So Tom, while I punch up your slides, if you'd like to introduce yourself.
Sure. Hi, Tom Hofstetter. I'm a partner with the firm of Schenck, Smith & King in Florham Park. We are a full-service firm, and I co-chair the banking practice. And one of my specialty areas is SBA lending, and I represent bank and non-bank lenders, and we work with their primary programs, the 7A program and the 504 program, which we're going to highlight and talk about today, which are the primary funding programs of the SBA. So we're gonna delve into that a bit, and I've prepared a PowerPoint we're going to kind of go through quickly, but at the end of the day, there's a wealth of information that you'll be able to have access to and download later. But I'm going to just go through the high points of these two programs. And, with Matt, we can answer some questions, how you go about getting financing and, how you work with, the financing partners that deal with the SBA loan products.
And Tom, I'm rude, so I may interrupt you with some questions that Sure. I think the audience may have. So go right ahead.
Okay, thank you. Okay, so the topic of today's session is fundamentals of SBA lending. And the two primary programs, we're just going to move on a little bit here. Let's see, that's, okay, yeah. We're going to talk about the two primary funding programs, the 7A program and the 504 program. We're going to compare the two and kind of do a discussion about what they are. The first primary program, and it's the broadest program, and we can move on a little. Yeah, this is good. Is the 7A program. The 7A program is a guaranteed loan product which is offered through SBA lending partners, which are lending institutions. These are depository banks and or non-bank lenders that have a license with the SBA, and they provide financing for a multitude of uses. And the beauty of the 7A program, it's for small business, and we'll talk a little bit later what a small business is in general terms, but it's to provide financing that may not otherwise fit within a lender's conventional loan profile. There's a certain credit enhancement, and the credit enhancement is given by a guarantee. So the lenders are motivated to make the loan based on a guarantee of the full faith and credit of the United States government through the SBA to provide access to capital for certain projects. And the 7A program is broad. There's a broad range of uses, and we'll talk about that. The maximum SBA 7A loan size is $5 million, and they go to very, very small loans under various aspects of the program. There is a cost to doing these loans, and it's on a graduated scale based on the size of the loan, and it's between 2.77% to 3.75%. That's what it costs a borrower to. Those are a point spread that they would have to pay to participate in this program. But what they get is a much longer term loan than you would get under a conventional loan product. Interest rates on these are really based on prime. They're variable mostly. They can be fixed, but mostly they're variable from a spread from Wall Street prime to about to 2.75%. So that's really the range of interest on these loans. I guess the downside is now we're in a rising interest rate environment. These are subject to adjustment, unlike the 504 program, which is a fixed loan product.
So Tom, let me before. So I do a show called Family Business World on RV and television, and I interview a lot of family businesses, and they've been around more than 50 years. I said, how did you start? And they almost all started with a character loan from the bank. That they had no credit. They came over from, Europe and have a character loan. So is this an intent of the government to because right now banks can't lend. They can only lend if you don't need the money. So, is this trying to compensate for that?
Yes, it really, there is an element of character. You have to have good character to be able to apply for a loan, and it really is a substitute for that. And the government, backs it up with their guarantee. They also look for collateral to the extent that it is available. But just because collateral is not available doesn't mean that they would not otherwise have. Enable their guarantee for this loan product. So that is a major advantage. So you have some folks that are new to business. They're starting out. They maybe they don't own a home, but that's not a complete impediment to getting an SBA loan.
Excellent.
So collateral shortfall is not necessarily a problem.
A problem. Great. And Matt, you've worked with people doing this, getting these kinds of loans, right? Yep. Perfect.
Yeah, absolutely. Yeah.
Yeah, and again, where you go to get these loans, it's through your through your local bank, and then there's a lot of incentive for banks to do these. Not only do they get the guarantee, which enables them from a credit standpoint to make these loans, there's also another incentive to the bank. There's a secondary market where they sell these loans on the secondary market. And they can be quite profitable to a bank. So a lot of lenders, they have active SBA loan departments, and they're very profitable. They're a profit center for a bank. So they're very encouraged to make these loans. They also have other requirements. There's something called the Community Reinvestment Act, where banks are judged on providing equal access to credit to the community, and there's an incentive for banks to lend broadly throughout various communities, and so they're graded on that. So the SBA loan programs help facilitate a bank's Community Reinvestment Act.
Interesting. And it's interesting. So the lender must certify that they would not give this person a loan otherwise.
That's right.
Yeah.
Well, and as we get into this a little bit more, one of the criteria for making a loan is that the borrower does not have other access to capital. So there's like what they call a credit elsewhere test, where if they do have substantial assets, they do have substantial resources, they may not otherwise be eligible, for this type of
right.
loan.
Okay. And I'm skipping through a little bit some of the interest, because this is great. This is stuff people can read, but it's very nicely laid out.
Yeah, so it kind of goes through it. Again, your interest rates are variable on this, and again, that should be something to consider going forward on these loans, especially in this rising interest rate.
Yeah.
But one of the other major advantages of this loan is, as I touched upon earlier, is you have much longer loan maturities than you would on conventional loan products. So if you have a fixed asset or real estate, You can go out as far as 25 years on these, and most banks they won't go. They'll do balloons at 10. They don't usually go out to 25 years. They will go up to 10 years even on equipment loans or working capital up to 10 years. So I mean that's quite a nice advantage as well.
So Tom, explain to me, and again, I like to ask questions that why is there a penalty if you pay something early?
Well, yeah, well, it's a good question. That's a statutory requirement, and the government has a fancy word for it on a 7A loan, and that's called a subsidy recoupment fee. And that's only applicable for longer term loans. It's almost like the cost of capital. So they require and this is a subsidy that, because the government subsidizes this loan product. Right. So it's a subsidy recoupment, because every year in the budget, and just last night, Senate signed the appropriations bill, which right. continues the funding for this program. But there is a certain cost. So they want to recoup that if loans are paid off earlier. And so they will impose that for maturities that are in excess of 15 years. There is no prepayment penalty on these loans for less than 15 years. It's really your longer term loans, such as a real estate purchase or something along those lines. But I'll have to say the average SBA loan historically is about 7 to 8 years. So most of them, that's really the typical life of a long-term SBA loan. Yeah. But lenders are incentivized to make a as long a term loan as possible, because that translates to the secondary market. Because the longer term loan that they have the guarantee, to get a higher premium when they sell their loan. Okay. The other thing I should mention as part of the collateral, they will take collateral to the extent that it's available. So if you do own a home or other assets, if there is a collateral shortfall, they have to take enough collateral to justify the loan on that basis. However, and you mentioned folks without any collateral earlier, to the extent you could have equal borrowers. Somebody owns a house, somebody doesn't own a house, they will still make the loan on that basis. But the person that has the asset will have to pledge that. Also, with an SBA loan, there's a personal guarantee required, no matter regardless how strong of a borrower, and that's imposed for ownership interest of a borrowing entity of 20% or more.
Now this is some good stuff about lenders, but okay, small. So talk about small. So
yeah. So the whole idea. This is the Small Business Administration assisting small business. So the SBA determines eligibility on the size of the business, and they basically go to the NAICS codes, and they have various standards of what is a small business, and they have general formulas. I have a couple slides that kind of gives you what a small business size is, and it's based on the industry classification. I'm just trying to run up to my slides. I get a couple.
Tell me what page it is.
Yeah, I'm just trying to go through that right now. Yeah. But and that applies for 504 loans as well as 7A loans. But usually it's like less than 500 employees, and then for each industry standard, it is, let's see, where am I?
So here on page 22.
Yeah, if you go to slide 22. Slide 22.
Yep.
So slide 22, again, they base it on the NAICS code, and then they have it to the extent it doesn't fit within, the NAICS is the North American Industrial Classification System based on industry. But there's an alternate size standard they can use if it doesn't quite fit that parameter. But it's the general alternate size standard rule is like 15 million or less of revenues, or a two-year average net income after federal income taxes of 5 million. But if you go to the next page there, they talk about for manufacturing classifications, like anywhere from like 500 to 1,500 employees. Wholesale trades up to 100 employees, and these are just examples. They have if you go to their NAICS codes, it's like page after page after page what industry you're talking about as to what is considered a small business.
Right.
Now they also consider as to for a business these loans have to be made to active businesses. They can't be for passive entities. So
Right.
your real estate investment entity is not eligible. So if you have somebody going out and buying a strip mall, for instance, and they're using that for investment, or they're buying a multifamily housing project, that is not eligible for this type of financing. The business has to be a for-profit business.
So Tom, again, and you'll say I'll throw, some curveball questions. So, there are a lot of people made up these fake business names. There's one called like FU Government, and they got $100,000, and the other legitimate businesses were denied. And so, how does that, you're a lawyer, and so, I mean, how does that happen? How do people, is it the local bank isn't screening, or
Well,
how?
I think you're probably talking about fraud under the PPP program.
Yeah.
Yeah, so the PPP program was a very different SBA program.
Right.
That was produced under the CARES Act, and frankly that was rolled out so quickly.
Right.
And the SBA is a really small agency. Well, they were tasked with administering the CARES Act and the progeny of the CARES Act, but the volume of loans were
Too much.
It was, I believe, in the first year, it was 10 times the amount of loans that they had ever done all through the existence of the SBA. So it was an enormous amount of loans,
Wow.
and that's all coming back to it now. A lot of fraud is being uncovered.
Uncovered.
You had a lot of fake entities. You had a lot of uses that just were not eligible. And now the chickens are coming home to roost, and the SBA and the Department of Justice are being very active in pursuing some of these fraud cases. Some of the first convictions are just starting to show up right now, and they're taking it very seriously. However, I just know, I mean, my firm and my department was very active in counseling banks throughout this program, and we've been involved in several fraud cases and referrals to the Office of Inspector General. So that's something that's going to unravel, and we're going to be hearing about for years to come, unfortunately.
Yeah, I think that's, but this has a lot more controls on it, so you're not going to see that kind of nonsense.
Yeah, you see, the PPP loan program, I'm sure many people in the audience were familiar with it. In fact, many people in the audience were maybe the beneficiaries of that program, and it was a great program, plugged a lot of holes, and it really got us through some of the bad days of the pandemic. And some say maybe it put too much cash into the economy. That's why we have such inflation these days. But the controls, to your point, were not like the controls of the programs that we're talking about. So they were just putting massive amounts of cash into certain small businesses that were not otherwise eligible under these programs. One of the big areas that they lent to, which is not it's not eligible under the 7A program, is that not-for-profits were eligible under the PPP loan program. Under the 7A or 504, by definition, you have to be a for-profit entity. So a not-for-profit can own a profit entity, and that profit entity would be eligible. But there's financing under the 7A or the 504 program is only limited to for-profit companies.
Right. So these are the permitted proceeds. So on page 24.
Then that's the beauty of the 7A program versus the 504 program. 504 program, we'll talk about that in a little bit, is a little bit more limited in the scope of what it can be used for. And here, I mean, we give a list of all the items. You can do it for your business expansion or renovation. New construction, that's another great area that you can construct. You can buy land and build a building. One of the great examples, somebody's been renting their building for years. They can swap renting to ownership, and that's very encouraged under this program. It's also available for you can purchase the lands, leasehold improvements. Another area which is not typically eligible under 504 program or other programs. There's a provision to provide working capital. You can get pure working capital loans with a long term out to 10 years. You can do it for inventory purchases. business acquisitions. I'll just make a comment about business acquisitions. If there is we do a lot of deals that are, and again, this goes with family businesses. We do buyouts between family members, change of ownership, also, complete business purchases, and we do a lot of deals, with transitions and family businesses using this program, as well as just complete, buyouts. The one restriction is that when there is a business acquisition, there has to be a complete change of ownership. So if you have, partner A, partner B has to buy out the entire interest of partner A. Partner A can't hang on there. Or if somebody, you have a new person buying an existing business, they have to buy the entire business.
And what's the rationale behind that? What are they concerned about?
Well, that's in the infinite wisdom of the statute, is that
Right.
by financing, they want to encourage a complete change of ownership, not just necessarily a buy-in. That's just
Right.
how that's the other thing I can make a comment about 7A. Some of it, is not logical, because it just goes to the act that provision was created under. So in the infinite wisdom of the legislators that passed that, they had various restrictions on the floor, and for some reason or some condition at the time, and it ended up in the legislation, which then ends up into the lending rules. And the lending rules under the 7A and 504 program are under a set of rules called the standard operating procedures, and they go into great detail. And I won't talk about that. I could spend hours talking about the standard operating procedures, but everything that I am talking about are found in what they call the SOP 5010-6, which is a set of rules that the SBA has adopted to implement these programs that are promulgated under various regulations that have been passed. SBA has been around since like 1953.
Oh, really? I thought it was even older than that. Matt, let me ask you real quick. What are some of the, as you work with folks, what are some of the challenges businesses have had with the 7A program? Have you, or if any, I mean, have you found any, what have you found helping? What have you helped people with related to this?
Well, typically when it comes to SBA loans, we're helping people help develop the business plan, get their bank portfolio ready to then go approach the bank and present that. One of the issues I think a lot of clients run into is the work that is requested as far as the documentation. So tax returns, if you're buying a business, the business tax returns, the business plans, all these things that you need to compile before the bank can even pass it off to the SBA. And another step in that too is oftentimes, especially now with all the programs the SBA is in charge of and dealing with, there's a pretty significant delay now from the SBA approval. So the bank may approve the loan package, and then they send that up to the SBA, and then it has to be approved. So some people are getting delays of they're ready to go with the bank, but they have to still get the secondary approval. So that's one aspect that some of our clients have been running into.
Very helpful. Very helpful.
Yeah, I mean, moving these loans forward sometimes can be, difficult. It's actually when we talk about the 504 program, that tends to be a little bit more cumbersome for a lot of reasons, and that's another advantage of the 7A program. And once you get through that, other than some of the, nuances that are in the SOP, I mean, at the end of the day, they're conventional, loans. And again, the one thing I want to emphasize is that these are loans from banks that are guaranteed. These are not direct loans from the SBA. I'm sure many people in the audience are familiar with some of the other SBA programs, the debt disaster relief programs, and most recently, which is very popular under the CARES Act and otherwise, were the EIDL loans that were promoted to businesses, and those were direct loans from the SBA. So these are distinguished because these are loans from the banking and the lending community as partners with the SBA, where those other loans were direct loans from the SBA.
Right. And what's this? Is curious. Credit elsewhere test. What is that?
Yeah, that's what I was touching upon before. The credit elsewhere test is that in order to be eligible for this loan, that a borrower does not have access to credit elsewhere. So they don't have sufficient assets. They have a pile of funds that they could otherwise use themselves. They have such good credit that they could just go to a bank and get a conventional loan. So the bank has to basically certify that that borrower cannot get credit elsewhere but for this guaranteed SBA loan, or this loan would not be made to that borrower it would not be made to the borrower, notwithstanding that there was a guarantee in place. So in other words, the guarantee is the reason why they would lend to that borrower for that type of loan. I mean, and we do a lot of special use financing. There's a lot of in the SBA industry. There's a lot of loans to franchises. There's a lot of loans for franchise purposes, and also for the hospitality industry. And lenders would not otherwise lend in that particular industry unless we had a very strong borrower, but for the SBA guarantee.
Well, most of this criteria, sound business purpose, invested equity, long-term success. Now, how do you measure good character and reputation?
Well, I mean, they do. Basically, good character is based on a background check. They'll if you have a criminal background, those types of things. So
interesting. Okay.
So if you've been, the application process is, I noted here on the slide, form 1919, 1920, and some of the questions they ask on that form, have you been, have you been charged with a crime of, moral turpitude or something along those lines? That's what they determine as to good character. If you've been convicted of a felony, chances are you're not going to get approved for an SBA loan. I mean, they were even at one point, they're as strict. If you've ever been arrested, they would preclude people from getting SBA loans, but they've loosened that standard quite a bit because, in various incarnations in our history, people get arrested for various reasons that are not considered a bad, moral character.
Right. Well, good. You want to move to 504?
Yeah, 504. Okay, so 504 is a different kind of program, and the one main advantage over that is you get a long-term fixed rate loan, and they're either 10 or 20 or 25 years, depending on the length of term of the asset. And that program works very differently than the 7A program. And basically, the structure on that is, I can go to slide 31 and kind of explain the structure. Basically, you have a lender, you have a certified development company, which is an SBA licensed non-for-profit entity, and basically they partner together in conjunction with SBA. So the way that works is you have a lender that's willing to have a 50% conventional loan, and it's an advantage for a lender to have a 50% loan because at the end of the day they'll have a very low loan to value, so it's attractive for a bank to only be exposed 50%. You have a CDC who comes in, and they have a CDC, a certified development company, it's a non-for-profit, and they have the ability to issue debentures into an investor pool, and they would be they would provide capital up to 40% of the project. A borrower has to invest. I mean, these are under general terms. 10%, or if it's a special use property, 15%. So the borrower has to have skin in the game, either 10% or 15%. The bank would be exposed 50%. The CDC is really a conduit, would offer debentures through a pool where the SBA would guarantee those to 100% to the investor for that 40% piece, which enables the CDC to have a 50% loan to value. Now, to get that structure, it just makes it a bit more complicated to close the loan. So in order to close the loan, and there's a whole bunch of varieties on way to do this, and the other disadvantage is because you have basically two separate lenders. You basically have a bank or non-bank lender that would be exposed for the 50% piece, and the SBA who would be guaranteeing their loan at a subordinated 40% piece. There's a timing issue with getting these all closed. And on a very basic level, if we had, and you have to have a completed project. I mean, they do provide construction financing under the program, but that gets to be kind of complicated to talk about today. But in a perfect world, you have a borrower buying a fixed asset, say a piece of real estate. They have 10%. It's not a special use property. They put their 10% down. They go to a bank, they get a bank loan commitment for 50% of the loan, and they go to a CDC and they get a commitment for the 40% piece. Now, in order to facilitate the funding of a bond sale for the 40% piece, there's a gap period. And because the bonds are only sold on a monthly basis and on a bi-monthly basis for 10-year loans. So you have to facilitate that gap period. So if you closed on day one, the bond sale may not be for another several weeks on a simultaneously basis. So you might ask, how do they fund that gap? Well, they fund that gap where the bank will fund a bridge loan for that period between when you close on your loan. And actually, I've got several of those loans closing today because I have a bar date of Monday to get all my packages in so they can be funded in April. So the bank will provide a bridge financing. So when they close, the seller is selling their building, they will get all their money. They'll get the 10% from the borrower. They will get the 50% term loan from the bank. And then the bank will fund the 40% remaining piece on a very short-term basis until the bonds are sold. So it gets to be a kind of a complicated formula on how to close, because you're essentially closing 3 loans to get to 2 when the bond sells. So it is a complicated structure. There's a lot of timing issues. I'm sure Matt can talk about that. A lot of timing issues to marry certain, you might have time of the essence problems with the seller. So you have to sell on a certain date or whatever. You have various approvals that you have to that are time sensitive from the SBA standpoint, and they have to all come together. Otherwise, if it doesn't, it gets bumped to the next month. So you really have to be on it to close these loans. They're a little bit more unwieldy as opposed to a 7A loan. But at the end of the day, what you get out of this is, from the bank standpoint, they get a 50% loan. They're exposed only 50%. Since they're only exposed 50%, their terms are going to be a lot more liberal. So the borrower gets an advantage of a longer term, lower interest rate loan. And then on the 40% piece, you get a fixed rate loan for anywhere, if you're just buying equipment and the useful life isn't that long, it would be 10 years. But if you're buying real estate, for instance, it'd either be a 20 or 25-year debenture, and you're getting a very low term fixed rate loan, and current rates are, a little over 3%. Fixed for 25 years. So that's a very major advantage. The one disadvantage is on the debenture piece, there is a breakage fee that because you're guaranteeing that low interest rate for that period of time. So for the first 10 years on a long-term loan, you're subject to a prepayment penalty, which is on a formula, which is more akin to a breakage fee. So there is a cost about refinancing a 504 loan, and so there is some disadvantages in that regard. So they can be more costly, but at the end of the day, you're not inclined to refinance because you're getting such a good deal.
Right.
So again, it's a great program. The other aspect, these are really they're more limited in use to the 7A program. It's traditionally it was a fixed rate or fixed asset program, where it was either for like buying real estate, buying long-term fixed assets, machinery and equipment that had a long useful life. More recently, they do have a refinance program where they will allow refinance of loans that would otherwise have been eligible for SBA financing when they were made. So somebody can go in, if they took a conventional loan, they bought a building, they can go in and do a 504 refinance as if they were doing one at the initial stage and be afforded all the same benefits. And that's been a very popular program.
Interesting.
That we're active in.
Yeah. And I like this. So the goals of the program.
Yeah, I mean, the goals of the program is they're partnering, with the private sector to provide financing, and they're providing all sorts of incentives, like, we're talking about Community Reinvestment Act, providing, incentives to the lenders. There's a secondary market, which is profitable in the 7A program. They have, a very low exposure to a bank on a 504 program. The one thing I can say from a lender standpoint, to do the 7A program, banks really need to be in the game on that one. They really have to have a experienced staff that handles the program. So I counsel a lot of banks that to get into the program, but they have to make a major commitment, because they are judged on the on their success or failure, and because the bank wants to make sure that they're lending in a safe and sound manner. On the 504 program, at the end of the day, the lender really doesn't have to do anything special in their portfolio with respect to SBA, because at the end of the day, the 50% 504 loan is a conventional loan to the bank, and basically a borrower. It's also good for a borrower too, because then they're just dealing with a conventional product with the bank, and they help develop a relationship with the bank on a conventional basis. So that's another advantage to a borrower under the 504 program. That kind of gets them into that next tier of lending, as they're growing their business.
That makes fascinating. I mean, there's so much. I mean, how do small businesses know this? I mean, obviously SBDC, and Matt,
Well,
if you didn't have an SBDC, what do you do? I mean, you're busy doing your business every day. It's I don't know. Tom, Matt, I mean, this is a lot of information.
People like Matt, I think they do they're a tremendous benefit. I'm sure Matt can tell you about SCORE, the retired business people that go out there in the community. I am personally active in two trade organizations that advocate these programs, and I'm an advocate for one of the associations that I'm involved in is the National Association of Government Guaranteed Lenders, that I'm an instructor for, and I do outreach. My outreach is mostly to lenders to get them to participate in the program. The NADCO is another one. That's the National Association of Development Companies, and they basically represent the 504 industry. And some of the interest there is to educate the community about the availability of 504 loans. So that's kind of how we go about doing it. And then of course you have your local SBA offices that's their function, is to go to get the word out, and they meet with various chambers to get the word out about these programs.
Matt, you have some thoughts?
Yeah, and I would say, luckily, we've really seen the SBA program expand over the last, 10, 15 years. And especially when we're facing economic downturns, that the banks tend to lean on these programs a lot more. When the economy's booming, everybody's doing well, there's a lot of money going around, banks tend to, push more on their commercial side for their own loans. But, luckily that's most of the lenders now either have an SBA lender, SBA person in-house, or in a close branch, or somebody very close that they can tap into. Years ago, they would have to send this way off to their headquarters, and it'd come back, and it was a long process. And, developing the working relationship with your lender is really important, especially the SBA side, because they can break down some of, it seems like a lot of details and things for eligibility for these programs, and it is, because it's federal money. But a good relationship with your SBA lender, they can help break this down and see what works for you. Do you qualify? Those sorts of things. And sometimes there's stipulations. We have a client right now that they were a little bit under as far as how much money they had to put down on their project. They were, I don't know, about 18%. The bank wanted them to be about 25. So they said, let's see if we can put it through an SBA program loan. And what we found out is they were looking to purchase the building that they operate in, and there's a 51% capacity requirement for that. So they had about 30%. They were going to buy the building, rent out the other space, and keep operating the business. So, there's a lot of things that you may think that you're fine for. And as soon as you get into, the nuances of the eligibility for these programs, and that's where it's important to have a good relationship with your lender, because they can help break this down as well.
Is this the kind of program that if you make a minor mistake, like some things, you're in real trouble? I mean, are they a little lenient? But is that, Tom, you're shaking your head?
Well, yeah, I mean, that's the difference between the 7A from a lender's standpoint. from a lender standpoint, yeah, the SBA holds, and there's a lot of discussion, and it also changes with the political environment. But I can tell you right now, under the 7A program, lenders are subject to audits. They are held to a very high standard, and part of what I do as a lawyer is when I'm representing a bank is, at the end of the day, I want to protect and preserve the lender's guarantee. So we close in accordance with all of those requirements. Now, on the 504 basis, from a bank standpoint, that loan, if they just kind of go along the coattails of the CDC, there's certain restrictions of what they can do. They sign a 3-party lender agreement. Those loans are going right into their portfolio, and then they're just judged by their regulator at that point. They have to lend on a safe and sound, basis. So yeah, I mean, they are held to a high standard. Yeah, and also the SBA, at the end of the day, they provide all these incentives. They want these loans to be paid back. So to your earlier point, if there's fraud, they're going to go after somebody pretty heavily, and with stiff jail sentences if there's fraud committed, in these loans. Now, touching upon what Matt also was just saying about, how do people find out about this? I can tell you, I mean, I'm an old guy now, so I've been doing this a very long time, and when I first started getting involved in this about 25 years ago, SBA loans were like considered the loan of last resort. Accountants, that's another area where borrowers find out about these programs through various accountants, and a lot of the banks partner with accountants to get the word out to prospective borrowers. But accountants would say, forget about these loans. They're too difficult to close. They're just crazy requirements, take forever. It's not worth it. That may have been true 25 years ago, but these loans that were once considered loans of last resort are really on the front line now, and they're really considered mainstream loans. And there's enough people out there that know about them that can help guide you through the process. And people, like Matt, can set you on a good path. And I don't even know 25 years ago if SBDCs really existed at that point. So I think what you guys do is a tremendous role in getting the word out about these programs and partnering with various lenders.
Well, I think I know they did, because I was at Wharton. I was in the SBDC, so that was more than 25 years. But
okay.
but they really have become much more important now. And really, I mean, again, I don't want to get into, but the federal regulations on banks have just made it harder and harder and harder for small businesses, and so now the SBDC is more important than ever. Matt, wouldn't you say?
Yeah. I mean, getting clients bank ready is a long process. It's not just, I'm going to whip together a business plan and go in there and get my money. You have to learn how to talk to banks. You need to get everything in line, in order. You need to understand what you're going in there and asking for, and what programs you could qualify for, and have those conversations. And most of our time for clients that are looking for financing, it's a long process of kind of coaching and mentoring and developing to say, do you have everything in place? Do you know what you're going to go in there and ask for? Because some banks, they're looking for a reason to say no. And if you're prepared and you have everything in line, you make your chances a whole lot better.
Kevin Curran's a regular watcher, and he always has good questions. So he says, can a 504 loan be used to refinance a 7A loan?
Yes, under certain circumstances, it can be. Yes. Mm-hmm.
Oh, really?
Yep.
Okay.
Yes.
And, what generally what kind of circumstances?
Well, it would have to be under the same circumstance. If that 7A loan was eligible for 504 financing in the first place. So it could be, yes. Mm-hmm.
Interesting. And again, we'll make sure everybody gets these slides, because there's a lot of good detail on the slides. Just going through.
There's a wealth of information here. We touch on, I mentioned before about the 5010. The 5010 is the standard operating procedures. To the extent somebody wants to do a real deep dive under the 504 and 7A programs, it's about 400 or 500 pages of information which spells out all the rules in detail of how what is eligible and how you can close a 7A or 504 loan. It gives you way more information. A lot of it is always not that clear, but that'll give you all the information up to funding of what you need to do for a 7A and 504 loan.
And really every business should, this is the power for number 42, page 42 is, I mean, every business should be preparing this stuff. And so many, I don't care what your size is, your personal background, your resume, a business plan, you know, personal credit report, bank statements, collateral, income tax returns, financial statements. Yet so many businesses don't, even for, you know, NJA loans, don't have this information. And so one of the things you got to do is put it digitally now. If you're horrible with paperwork, put it digitally.
Well, I mean, we part of what we do too in our firm is, you know, we do counsel people, you know, starting small businesses, and you know, what we always counsel is to try to develop a good, you know, get your thoughts straight, get a good business plan together. And I can tell you on SBA.gov, they have a great template for a business plan that you can go, that somebody that wants to start a business, that you can really think about what you need to do to get started. Another avenue is going to at the various, you know, community colleges, and also through Matt, you know, to sit down and meet with a SCORE representative, one of these retired executives that can give you some great helpful advice on what you need to think about and starting a business. If anything, they'll tell you some great war stories about what it's like to be in business.
So a couple good questions. So another one, Jim Perez, our friend. Jim, how you doing? With respect to these two programs, 7A and 504, are there limitations or guidelines on how employee-owned companies, ESOPs, or worker cooperatives can take advantage of these loan programs?
Yes, there are specific provisions for ESOPs, you know, to get involved. It's a very technical part. You know, to answer the question, I would need to know some of the details, but it can be complicated. But they do recognize, and particularly under the 7A program, not so much on the 504 program. There are provisions involving financing with the ESOPs in an existing company. Yes.
Kevin has another question, so follow along. If co-owners A and B want to buy out other co-owners D and C, could A and B use either a 504 or 7A loan?
They can't use a 504. They can use a 7A.
Well, they can use a 7A. Okay, good.
Yeah. Because like as I was mentioning before, the 504 program is primarily for fixed assets or refinancing of a loan that was used for fixed assets. You know, equipment, machinery, real estate. 7A program is much broader. It does that facilitates change of ownership. So if he was interested in pursuing that, 7A program is a perfect vehicle to do that. Again, you're talking about loans. The maximum loan size is $5 million on a 7A loan. That's guaranteed at 75% to the bank. But I can say there's another provision that allows a larger 7A loan, and that's lending on what they call a pari passu basis, where they will allow a larger companion loan to accompany a 7A loan, provided that the lender or lenders share equally in the collateral. So you could have $10 million pari passu 7A and conventional loan, where the $5 million SBA lender, and oftentimes it's the same lender, would share the collateral equally with the conventional lender. So you could go larger on a 7A loan.
Perfect. No, that's great. Great explanation. So just this second line is interesting. So loan requirements should match credit requirements. What does that mean?
Well, I mean, again, this is, you know, part of the things that I do when I document these loans are that, you know, and sometimes the credit department of a bank doesn't necessarily translate to the operational group. So they'll approve a credit, but that does not necessarily translate to how the loan is structured. They don't necessarily structure the loan. So that's really more from a representing a bank perspective.
Right.
And what I do is, part of my job is I take the bank's credit memo to make sure that it matches their loan commitment, and then the document that authorizes an SBA loan to be used is called the loan authorization. There's a 7A loan authorization or a 504 loan authorization, which basically starts the ball rolling for the SBA's involvement. So at the end of the day, a lender wants to make sure their credit matches their commitment, and then it ultimately translates into the SBA loan authorization.
Perfect. Well, this is great. I mean, there's a lot of details. We'll make sure to get the slides out to everybody.
Yeah, there's a wealth of information in there. We only touched upon a lot, and there's a lot of nuances, on there. But I hope that spurs, some questions. And certainly, if somebody wants to reach out to me after this, I'm very happy to have a conversation about these programs, or to refer them to other lenders, or and other avenues to assist them.
Excellent, Tom. And so let's talk a little bit more about your practice. What other areas do you work in your legal practice?
Well, I mean, I co-chair the banking practice group,
Yeah.
where basically, we handle all sorts of transactions for lenders. My practice is national, so I consult with lenders all over the country, and I primarily do that in connection with the 504 and 7(a) loan programs. We also, in our firm, we're a full service law firm, so I'm part of our corporate practice area, and so we work hand in hand with our corporate group that'll help structure a transaction, particularly buy sells of businesses that will translate into financing. And also we work closely. We have a very large trust and estate practice, and where we get involved in family businesses and things like that. So we will come in and assist transactions with family businesses, and also, even though it's not such a big area of 7(a) lending, we do a lot of financing with non-for-profits and with other products. So that's pretty much what I do, and I like to consider myself an advocate for small business. So I partner. I chair the Region 1 and Region 2 lending committees for our trade organization, which we partner with the U.S. Small Business Administration. The Small Business Administration is set up in regions throughout the country. So I chair Region 1 and Region 2, which is New England, New York, New Jersey. So that's
really? Wow.
Yeah, so that's a big part of my practice. And then I'm an instructor for Nagel, so they send me to various places, not so much during pandemic, just starting up again, where I train and teach lending departments on how to document SBA transactions.
Interesting.
And I also work with, I'm also considered an SBA designated attorney, which allows me to represent certain certified development companies, and so they can offer their bonds on a easier basis. That's kind of my practice.
Well, you're deep into this. This is great. And
Yeah, well, this all started. I started in a large law firm, and then I had worked for the Federal Deposit Insurance Company for a variety of years, and basically was a liquidator for the FDIC. And then I was a general counsel of a bank. And when I was general counsel of the bank, that basically they had a large SBA practice, which was under my purview at the time. And then fate brought me back into private practice about 25 years ago, and that's what I've been doing ever since.
Interesting. Are you involved at all with policy related to banking and small business?
I am to the extent of developing we mentioned the SOP. So, we're part of the industry group that advises the SBA, or advises the SBA of the problems of, like what you touched upon before. If something doesn't quite make sense, we try to work with getting legislation, adjusted so the rules apply more favorably to borrowers and lenders. I mean, over the years, there's been nuances and various interpretations which have provide an impediment to providing access to capital. So, I do work with a policy group. I'm on the technical issues committee of Nagel, and we meet with SBA to, when they come out with a new rule or regulation, we'll comment, and then we'll help work a rule. So I help write some of the, in conjunction with the SBA, I help write some of their rulemaking.
Really. Now, Matt, you guys track the loans and the success and so on, and how in New Jersey, how's the SBDC been doing with businesses and getting SBA loans?
So, the SBA loan side has really taken a hit from our perspective with all the federal programs and state programs for relief that's been out recently. So, a lot of our time has been dedicated to, shuttered venues and PPP and EIDL and all the NJEDA programs and those sorts of things. So we've seen a big shift towards basically the relief side in the last, say, 2.5 years, where before, most of our efforts, we're tracking the SBA metrics for, how many SBA loans we're helping people get in the communities and those sorts of things. So we've seen a big shift recently, but I assume if we don't have any more, outbreaks and things like that, that there's going to be a shift back towards, getting SBA loan packages through and getting the economy going back strong again. So.
Yeah, I mean, Matt makes a great point there. I mean, we've been, SBA has really gotten on the map because of PPP and and EIDL, loans, and that's really kind of been taking the forefront. There's also, and all these programs ran out. I mean, EIDL ran out in December, PPP ended last September, and also there was a lot of incentives for 504 fee. There was fee waivers and all that kind of stuff. That all basically expired last September. So we're all getting back in traditional, SBA lending now. Matt also mentions, the forgiveness stuff. I mean, that's going to go on for a while. Getting PPP loans forgiven. The correlation between PPP and EIDL. What you can use for unused PPP money. We get those questions on a regular basis. But very soon, we're going to get back to just sticking to the topics that we kind of highlighted today.
So one of the things, and I have to put this plug in because I work a lot with urban entrepreneurs and some of the more economically challenged areas, and so often that they don't have access to the information to even go to the local SBDC, and so as Tom, since you're so influential in this, to really let them know. I mean, they really have to go out of their way to kind of get the information to places like I'm pastor of a church in Plainfield. I live in New Brunswick. And so there are places in Plainfield, there are businesses would have no idea what we're talking about. Absolutely no idea, and barely have a bank account, other than what they do. And so I don't know how we do that. I don't know, Matt, if you have any ideas, but I think that's a big gap because the programs are there in a lot of instances, but the people just have no idea how to access it.
And I would say, the SBA is making some drastic efforts to improve their marketing, making things less complicated, just in the rollout of all the relief programs. Yes, there was lots of information and complications and, eligibility rules, but they were able to develop those things and roll them out pretty effectively that you could go and find the information once they kind of put it out there, right? So I think they've really invested internally through the federal government to push some of these programs, especially through the SBA, to make them more, public friendly, so you can actually understand what's going on, what programs are available, and those sorts of things. So we have seen a lot of effort with that. We've seen a lot of effort, especially with the opportunity zones and the EIDL advance grants, with those things that they've been targeting some of these areas through these programs. So I think there's going to be, I'm hoping there's going to be an expansion of, some of the SBA programs and offerings in the future, because we've seen things that have worked and learned a lot through this process of all the relief programs.
Yeah, and I do. I mean, that's what SBA through their local office in Newark. I mean, they're representatives. That's what they're doing. They're supposed to go out to the community and reach out. Also, these certified development companies have obligations to reach out to the community as well. You've mentioned the city of Plainfield, which is actually the city that my family is originally from, and where I was
really born. Oh, interesting. Yeah.
Where I was born, and but they have partnered with the mayor, and I've gone to various events in Plainfield, mainly because of my family history there, and they've promoted their program, in conjunction with Plainfield government. So I mean, that's kind of how they do it. And my CDC, they basically, I mean, I represent three, but my primary one, which is a Trenton Business Assistance Authority, I mean, they basically started as a micro lender serving the community of Trenton, and they've kind of continued with that, targeting various communities and outreach. They do micro loans, and that's another area too for a small business, is to go to your local certified development company, for smaller loans. And they have, and they're charged with outreach to various disadvantaged communities. And I know William Pasmino, who's the executive director there, I mean, that's a personal mission on his part. He does an awful lot of outreach to those types of areas.
Well, we will talk some more, Tom, and I came with this idea of this program called Entrepreneur Zones, and to really to work with opportunity zones, but really focus on the entrepreneurs. And so we got the state to do that. I'm sharing a statewide committee. That's how I met Kelly, the statewide director of the SBDC. And we're focused on Trenton, on really helping and creating an entrepreneur zone as an incubator, really an ecosystem of businesses. So I'd love to talk to you about Trenton and really doing that, because we wanted that to be a model of how, because we so often expect individual businesses to survive, but when you put them together in a collaborative, you can really enhance their chance of success.
Yeah, and I think with that discussion, to perhaps include William Pasmino, the executive director of the Trenton business, I think he would be very helpful, particularly in Trenton.
Excellent. Well, Tom, Matt, thank you so much. There's been tremendous information. As I said, we'll make sure to get this slide deck out to you. There's a lot of information. It's also useful because it tells you how banks are thinking too in your presentation, which a lot of people don't get. So I think that's important. So take care. Have a great weekend, everybody. Thanks for watching. And we will see you at the next Zoom at noon on Friday. Take care. Bye-bye.